right. Our next topic is regulatory environment. Regulatory environment, meaning that auditing as a profession works within regulations. That means the profession is being regulated. The key reason why audits and assurance services should be regulated is to serve the public interests. The reason why we need to regulate the audit profession is because of the public interests. And assurance providers give an impartial, professional view on issues that matter to users of financial and other information. It is important that this view can be trusted. Yes. Once the views are being brought out, it needs to be trusted. Otherwise, people will lose confidence in the information. Therefore, assurance providers need to operate within ethical boundaries. That is the one reason why we regulate the profession. So that the assurance provider, work within the ethical boundaries to consistent standards. To what? Consistent standards. You don't do this here today with this formula and then go to another one. So the standards should be in such a way that people operate consistently. You know from your previous studies that, this is not necessary, that assurance providers are regulated by the law of the land in which they operate. The law of the land in which they operate, the ethical standards of the land, and the professional body to which they belong. The professional standards adopted by their country, for example, international standard on auditing. So, in part 2, you learn all these things already. Assurance providers are given ethical guidance by professional bodies. So, who provide guidance to what? Those assurance, providers. The first one is professional bodies like ICA Ghana. In Ghana, ICA Ghana is responsible for making sure that all professional audit jobs are done within the framework. Then the law of the states, like the Companies Act and the rest, International Federation of Accountants, IFAC, they also, so all of us are within the range. That means IFAC, the law of the states, the professional bodies, all of them bring out what? The standards. Most countries have legal requirements associated with some assurance providers, particularly auditors. Examples of these legal requirements in Ghana can be found, for example, in the Companies Act of 1963, Act 179, Bank of Ghana Act of 2002, Act 612, the Banking Act of 2004, Act 673, and the Insurance Act of 2006, Act 724. These are some of the acts that the auditors need to what? Comply with. No person shall be appointed as auditor of a company unless, what qualify you to become an auditor? These are what we are going to discuss. No person shall be appointed as a company, that is auditor of a company, unless what? They have consented in writing to be appointed prior to such appointments. Meaning that you must be what? Consented in writing as to that you will be appointed as what? An auditor. 2, they are duly qualified. When they say you are duly qualified, means that you have done ICA Ghana and you have charter and you are given the license to practice. That is what I mean by you are duly qualified. A person is only qualified for appointment as auditor of a private or public company where they are a member of the Institute of Chartered Accountants. Yes, if you are not a member who is given the license to practice, you cannot be appointed as an auditor. A person may also be the auditor of a private company where they are a practicing accountant within the meaning of the Chartered Accountant Act of 1963. Before the coming out of 1963 Act, at 170, it means that there were some accountants in existence. Those accountants by then are allowed to practice, but they can only audit the private companies. The following people are not duly qualified for appointment as auditors for both public and private companies. So who qualifies and then who is not qualified? An officer of the company. Yes, any officer of the company can never be an auditor of any associated company or of any associated company. For example, you can be employed as internal auditor for a company, but you are not an auditor for the company in the meaning of the word auditors, because you are not external auditor. You are not going to give opinion on the financial statement. Yours is a different job. A person who is a partner of or in the employment of an officer. So if you are engaged by a partner to do any other job for you, you cannot come and become an auditor of that very company. And infants, anybody who is below the age of 18 years in Ghana, you can never become what? An auditor. Any person found by a competent court of what? Court to be a person of what? Unsound mind. Yes, somebody who is not well. And you are found by a competent court, that means you can act as an auditor. A body corporates. In Ghana, we don't have companies, auditing companies, no. Except that members of an incorporated partnership may be appointed in the manner provided by what? Section 134 of this code. In Ghana, we don't have companies that are, audit firms that are companies. You have companies, incorporated partnership. For that one is allowed in Ghana. Anyone in respect of whom an order shall have been made under section 186 of this code, so long as such order remains in force, unless leave to act what? As auditor of the company, consent has been given by the courts. So already we say that those who are not what? Qualified. Then undischarged bankrupts. Anybody who is bankrupt and has not been discharged can never be an auditor, unless he shall have been granted leave. So if you are granted leave to act as an auditor of the company concerned by the court by which he was adjudged bankrupt. So if you are bankrupt in Ghana, you cannot be an auditor unless that bankruptcy clause is removed from you. A person who is for the time being disqualified from acting as auditor of a company by instrument of the registrar. Any audit firm that is what? Disqualified by the registrar general, then that fellow cannot act as incorporation of the company or prior to the delivery to the register of the companies required under the Companies Act of 1963 at 179. Section 27. Notice of the names and addresses of what? The first auditors of a company must be given to the registrar. So if you are registering a company, the first registrars, their names and addresses should be given to the registrar. If a company later changes auditor, the registrar must be informed within 28 days. So anytime you change the auditors, you must inform the registrar general within what? 28 days. Companies shall also give notice to the registrar if at any time a continuous period of 3 months shall have elapsed, without the company having a duly qualified auditor. What it means that anytime there is a vacancy, you don't have an auditor for the company for 3 months. For 3 months, then it means you must inform the registrar general. Auditors shall be appointed by ordinary resolution of the company and not otherwise. Any auditor that is appointed is done through what we call ordinary resolution, through the ordinary resolution of the company. That means shareholders pass a resolution on you. However, there are 2 exceptions. There are what? 2 exceptions. So the first thing is auditors are appointed by the shareholders by passing a resolution on the auditors. The next one is that there are some exceptions. The directors may appoint the first auditors of a company and may fill any vacancy, casual vacancy in the office of auditor. So they are saying that first auditors are normally appointed by what? The directors of the company. And if there is any vacancy somewhere along the line, to fill that vacancy, the directors can also appoint auditors. The second one is, if a company has no auditor for a continuous period of 3 months, the registrar may appoint auditors. Meaning that if there is a vacancy, there is no auditor within 3 months, the registrar general can appoint what? Auditors. So there are 3 things we are saying here. The first one is auditors are appointed by ordinary resolution by the shareholders. 2, in absence of that one, auditors can be appointed by directors. The first auditors are usually appointed by the directors. The second one is, if auditors, there is a vacancy in the company for a period of 3 months without auditor, the registrar general appoints the auditor for the company. Every existing auditor shall continue in office until what? So whoever has been appointed as an auditor will be in existence. Okay. Every existing auditor shall continue in office until what? He ceases to be qualified for appointments. Then he resigns his office by notice in writing to the company, or an ordinary resolution is duly passed at an annual general meeting, removing him from office, or appointing some other person in his place, as from the conclusion of the annual general meeting. Yes. So every auditor that you appoint will be in existence for long. When any casual vacancy occurs in the office of auditor, the surviving or continuing auditor or auditors, if any, may act. So assuming that a company is auditing or a firm is auditing, then let's say the senior partner dies or something happened to him, the other auditors in that audit firm will continue until what? The tenure of what? That assignment. Where the auditor is appointed by the directors or by the registrar, remuneration of the auditors may be fixed by the directors or the registrar, as the case may be, for the period expiring at the conclusion of the next annual general meeting of the company. What this means is that anybody who appoints the auditor, if it's the registrar general who appoints, he will fix the salary, the fee for that, assignments. This shall be fixed by an ordinary resolution of the company, or in such manner as the company by ordinary resolution may determine. So what they are saying is that whoever appoints the auditor fixes what? The remuneration. Any sums paid or payable by the company in respect of what? Auditor's expenses shall be deemed to be included in the what? Expression remuneration. So what it means is that any amount that you give to is given to the auditors or fee charge is termed what? Remuneration, should be added to remunerations. In certain instances, the directors are empowered to appoint auditors. In some instances, the directors of the company are empowered by the shareholders to do what? To appoint auditors. However, it will not be appropriate for the directors to have the power to remove the auditors from office. They are saying that, yes, the directors of a company can appoint auditors, but they cannot remove the auditors from office. For example, it will be inappropriate for the directors to have the power to remove the auditors because there may be a disagreement between the directors and the auditors about an item in the financial statement or about the conduct of the audit. Yes, this is true. The directors can appoint, but they cannot They cannot remove auditors, because the directors prepare the financial statement, which are normally audited by the auditors. And therefore, there may be misunderstanding, probably in the course of the work. Due to this, if the power is given to them to they remove auditors, then it means something else. So they can appoint, but they cannot remove auditors. the directors could silence the auditors by dismissing them. Yes, that's what they are saying, that if that power is given to them to dismiss, it means they can do whatever they want. Clearly, it will be more appropriate for the directors to recommend the appointment of new auditors to the shareholders and for the shareholders to decide. The correct thing is that the directors can recommend appointment of particular auditors which the shareholders can approve or disapprove. In Ghana, a resolution to remove any auditor or to appoint any other person in their place is not effective unless. So, in Ghana, if you want to remove an auditor, there are conditions you need to meet. The first condition is that it is passed at annual general meeting of the company. If the dismissal is not at annual general meeting, it is null and void. Written notice shall have been given to the company of the intention to move it not less than 35 days before the annual general meeting, at which it is to be moved, and on its receipt, the company shall have sent a copy to the auditor concerned. Yes, if there is an intention of removing an auditor, that intention should be served on the auditor on the company 35 days before the annual general meeting, at which it is to be removed, and on its receipt, the company shall also give a copy of that letter to the auditor. The company shall have given its members notice of such resolution at the same time and in the same manner as it gives of the meeting. So you cannot just stand up and say you are removing an auditor. If you have intention, you need to serve that information on the company, and the company, after receiving it, will also serve the auditor the same. Provided you can do that, provided that if at notice of the intention to move the resolution is given to the company, an annual general meeting is called for a date 35 days or less after the notice has been given to the company. The notice shall be deemed to have been properly given. Meaning that if you have that intention, it means notice of the annual general meeting should also be there for 35 days. That means within 35 days. In the case of resolution to remove any auditor appointed by the directors or to appoint any other person in place of an auditor, substitute 14 days for 35 days and 7 days for 21 days. So this is in case of a resolution to remove any auditor appointed by the directors. The first one is appointed by shareholders. But now if it is appointed by directors, then you should substitute 14 days for the 35 days up there, and then 7 days for 21 days. So that is. The auditor concerned shall be entitled to be heard on the resolution at the meeting. So whoever is the auditor, once you are removing him, he is entitled to to be heard. He is entitled to be heard on the resolution at the meeting. Yes, he has to attend the meeting, and then he has to be given that thing, being a chance to be heard. To sign to the company a written statement, copies of which the company shall sign with every notice of the annual general meeting. Or if the statement is received too late, shall circulate to any person entitled to notice of the meeting. So meaning that notice should be circulated to everybody. Provided that the company need not send or circulate such statement if it is received by the company less than 7 days before the meeting. So you cannot circulate it when it is less than 7 days. If the court, on application being made by the company or any other person who claims to be aggrieved, so orders upon being satisfied that the statement is unreasonably long, or that the rights conferred on this session are being abused to secure needless publicity for defamatory matter, and the court may order the cost of the applicant to be paid in whole or in part by the auditor, notwithstanding that he is not a party to the application. Now, the auditor may, unless the court shall have made an order, also require that the written statement by him be read to the meeting. So it means that you must give them the times to what? Come to the meeting, and you must hear, you must give the time to also defend himself. If the resolution is passed, it shall not take effect until the conclusion of the annual general meeting. If you don't pass a resolution, immediately you pass the resolution, they say that unless the general meeting comes to a close, the auditor may what? Resignation of auditors. Since auditors are appointed, they need to be, they can also decide to resign. So resignation of auditors. The auditor may choose to resign during his period of what? Office. Yes. The reasons for this might include what? Some of the reasons why auditors resign are a consistent lack of integrity is demonstrated by management or those charged with what? Governance. Consistent lack of integrity. If you find that management is lacking integrity, you can decide to resign. 2, significant fees remain unpaid. That means the auditor worked and how to pay the money becomes a problem. The audit firm can no longer maintain its independence. Yes. Sometimes audit firms may be small. For example, may be small at the time that he's given assignment. But as the company grows bigger and bigger, it becomes difficult for the audit firm to be able to maintain that independence. Then the client is no longer profitable for the audit firm. Yes, sometimes auditors, they are not for the Christmas. They charge fees. So therefore, if one or two reasons the company you are auditing is no more profitable, you can decide to. In Ghana, any auditor who resigns must give notice in writing to the company. That's it. That is the law. Eligibility to act as an external auditor. Who qualifies to be external auditor? That's what the eligibility to act as an external auditor. Self-regulation by the audit profession. Yes. Eligibility to act as an external auditor is usually determined by membership of an appropriate regulatory body, such as ICA. So, for you to become an auditor, you need to be a member of what? ICA Ghana. The role of such regulatory bodies normally includes the following: offering professional qualification for auditors, establishing procedures to ensure that the professional competence of auditors is maintained. That is the role of what? Regulatory bodies like ICA Ghana. Okay. Maintaining a list of registered auditors, which is made available to the public. ICA has a list of all registered firms, audit firms, which if you are public, you are a company, you want auditors, you go there, they will show you the list of all audit firms. Such a system is referred to as a system of self-regulation. In such a system, the regulation of auditors is carried out by their own professional bodies, meaning that the ICA regulates all auditing firms. So it's a self-regulating The government may appoint a public body with similar responsibility to a self-regulating professional body. They are saying that the government can establish a body which will be similar to ICA to see to its regulations. The public body may therefore establish rules and procedures. That is not yet in Ghana. So that public body may therefore establish rules and procedures for the audit of public institutions. For approving, authorizing individuals to perform audit work. So that regulatory body, which in actual fact, if not ICA, or it's a different body, a public body, that will be in charge of approving, authorizing individuals to perform audit work. And then for ensuring that authorized auditors have the necessary minimum skills and knowledge to carry out their work to a proper standard. Yeah, they will see to all these things. and for handling complaints and taking disciplinary measures against what? Auditors, where appropriate. This may be done by. In addition, it is usual for statute law to establish that certain individuals are ineligible to act as external auditor in the context of a given what? Company. Even if they are a member of appropriate or regulatory body. Yes, they can bring out a law a law can be established to this, what do you call it? To make some audit firms ineligible or auditors ineligible to be external auditors. These exclusions are designed to help to establish the independence of the auditor. All these things we are talking about, they are done so that the independence of the auditor will be what? Secured. Local company law. For example, in Ghana, Companies Act of 1963 at 179 will usually what? Impose certain duties on the external auditor. Our Companies Act imposes some duties on the external auditor and grant him certain rights or powers to enable him to carry out his duties. So that is the rights and duties of auditors. Rights. Once you give assignment to somebody, you need to give the fellow a right to do the job. Rights and duties of auditors. So we are saying that local company law, for example, Companies Act of 1963 will usually impose certain duties on the external auditor and grant him certain rights to enable him to carry out his duties. So now let's go further. Duties of the external auditor again. The primary duty of the external auditor is to. So the main job of the external auditor is to examine the financial statements. That's the first one. And issue an auditor's report on the financial statement, which is then presented to the shareholders together with what? The financial statements. So there are two things there. One, examine the financial statements. Two, issue an auditor's report on the financial statements. This auditor's report will set out the auditor's opinion as to whether the financial statements give a true and fair view. So the auditor's report, which we said issue an auditor's report, the report will say find out whether the financial statements were prepared what? In the consonant with the financial what? Of the law, sorry. That's to give a true and fair view or present fairly the financial position and performance of the company and have been prepared in accordance with what? Applicable financial reporting framework. So I said applicable financial reporting framework can be the laws, can be the standards and the rest. The outcome of the statutory audit is an opinion on the truth and fairness of what? Financial statement. The word opinion implies that the auditor has applied his professional judgment in reaching his conclusion. Yes, it is an opinion because the auditor is trained as a professional and he's using the professional mind judgment. So in his opinion, the financial statement is true and fair. He's not saying factually, but he's saying in his opinion. This point is arguably one of the limitations of the statutory audit. The auditor report expresses an opinion, not a statement of what? Facts. Not a statement of facts. It is therefore open to disagreements. So it's an opinion, but not statement of facts. In carrying out his audit work, the auditor is unlikely to check every transaction undertaken by the company during the period. There is therefore a risk that the judgment he forms may be inappropriate because in performing the audit he has missed an item of what? Significance. You see, auditors, we don't normally do, especially when the companies are big, the transactions are big, we do sampling. So it means that it's an opinion. Some facts may be left out. So that's what we say in his opinion. That's in my opinion. External auditors have certain statutory rights to enable them. That is rights of the external auditor. We are continuing again. External auditors have certain statutory rights to enable them to perform their statutory duties. The main statutory rights of the auditor are given in the Companies Act of 1963 at 179, Section 136, and include the following. That section include the following. The right of access to books and accounts and vouchers of what? So, right of access to the books, accounts, and vouchers of what? The company. The right to all information and explanation from the officers of the company necessary for the performance of the auditor's duties. The right to receive notice of all general meetings of the shareholders. That's another right. And to attend those meetings. He has the right. The right to speak at any general meeting on matters affecting the audits or the auditor. Any issue that affects him at the annual general meeting, he has the right. This can be important when the auditors disagree with the directors of the client entity and are unable to communicate with the shareholders effectively by any other method. The right to apply to the court for directions in relation to any matter. So the auditors also have another right to apply for what? Directions in relation to any matter arising in connection with the performance of their duties. Responsibility of management. Yes. Auditors have responsibility. Directors have responsibility. So let's look at responsibility of management and those charged with governance. Those charged with governance are normally called board of directors. So with respect to the audits, and contrary to what many members of the public think, it is management and those charged with what? Governance who are responsible for. So meaning that these are the responsibility of what? Management. 1. Prevention and detection of fraud. Prevention and detection of fraud. It is not the auditor's responsibility. Preparation of the financial statement. They prepare the financial statement for the auditor to come and audit. Design and implementation of effective internal controls. So putting internal controls in place, designing it, implementing it, they are all responsibilities of what? The management. Continue. They are also responsible for what? Providing the auditor with what? Access to information relevant to the preparation of the financial statement. Yes. The auditors have what? Management is responsible for making sure that auditors are given the necessary support, necessary informations, additional information relevant to the audit, any additional information that the auditor needs. Unrestricted access to persons whom the auditor needs access to in order to complete the job. What they mean is that, yes, he has what? Unrestricted what? Access to persons. When you want the procurement officer, she should be given a chance to see the procurement officer for interviews and the rest. Providing written representation to the auditor at the end of what? The audits. So management is responsible for what? Providing written representations to the auditor at the end of the audits. So that written representation, we can see it later, detail later, chapter for details. And see later, chapter for details. Okay? Now, professional regulation. Auditors are required to carry out audits according to professional standards, which we call ISA, International Standard on Auditing. Some assurance work is also covered by what? Professional standards. Although this is a developing area and less guidance is what? Available. In many cases, guidance given in auditing standards can be adopted for what? Use in assurance services, where there is no specific guidance for that service. Let me read that again. In many cases, guidance given in auditing standards can be adopted for what? Use in assurance services, where there is no specific guidance for that service. What they are saying is that, auditors do audits and they also perform other services, audit-related services. Where those services that you are performing, there is no guidance or there is no standard on them, then you can fall on what? The auditing standards to do your job. And assurance provision goes increasingly global. The harmonization of what? Such professional guidance has become necessary, since audit now is almost as a global service. Assurance service that you provide is a global issue. There's a need to what? Harmonize or bring all the, the standards to what? One particular line, which means globalization. They are saying that you harmonize the standards and make it as one. That's where that's ISA, which is International Standard on Auditing, used in Ghana. It's the same thing used in other countries. The International Federation of Accountants is an international regulatory body for the profession, but each country has its own regulatory regime for auditing. That's harmonization. That's what they are talking about. How do you harmonize, make sure that all the countries all over the world, their auditing standards go into what? Fuse into one particular standard. And this one is done by IFAC, that is the International Federation of Accountants. And it is our international regulatory body for the profession. And they are saying that, but each country has its own laws. And therefore, they have their own, way of doing it. But they should fuse into the IFAC regulation. The same arguments that have been made in favor of the universal adoption of international accounting standards can also be made in respect of other regulatory aspects of the auditing and accounting profession. All chartered accountants all over the world they belong to what we call IFAC. That is International Federation of Accountants. And the International Federation of Accountants is the overall boss. So they come out with standards for both accounting standards, auditing standards, and all the other standards. So since they come with all this, every country also have their own laws and regulations. So the laws of Ghana must go alongside with IFAC. It should not be contrary to IFAC regulation. So IFAC brings all the regulations, but you must carve the nations or the country's standards from that of what? It's like an act of parliament is emanating from the Constitution of Ghana. Constitution is overall. Therefore, any act which contradicts that of the Constitution is null and void. The same argument that have been made in favor of the universal adoption of international accounting standard can be made in respect of other regulatory aspects of the auditing and accounting profession. Okay? These include advantages such as the adoption of global auditing standards, which Ghana is now adopting the IFAC regulation on auditing. That's International Accounting Standard, which should improve the efficiency of the audit process for multinational companies and should improve transparency in audit reporting. Yes, Ghana uses IFAC regulations or standards. So if you use international standards in auditing, and it is not different from what all other countries are using, then it makes multinational companies, audit of international companies, very easy, understandable, and effective. Disadvantages include the problems of getting international agreement on auditing practice. That is a disadvantage. And the need for many countries to change their local law to bring it in line with the agreed international practice. That is the only problem now. For other countries to agree that we all want to do the thing in harmony. Whatever is happening in Britain is the same thing happening in Ghana. but the country laws differ. So for Ghana to accept that whatever happens anywhere, we use the same standard to measure the performance. That is harmonization. Yes, a number of initiatives are taking place to harmonize the regulation of the auditing profession internationally. This includes the following. Audit of all listed companies in the European Union should now be carried out in accordance with international standards on auditing. Yes, that's it. Initiatives are in progress. Countries are saying that, yes, we all want to do the audit in accordance with what? International standard. And they are saying that as part of the initiatives, they are to harmonize the regulations, the auditing profession internationally, they are saying that these include what? Following. Audit of all listed companies in the European Union should now be carried out in accordance with international standard on auditing. So that is the regulation there. That is the policy there now, that any country that is within the European Union should use international standard on auditing. So it means that the auditing profession is now being harmonized. Okay? Move to establish a more formal statute-based corporate governance regime, such as Sarbanes-Oxley Act in the US. Yes. What they are saying is that that is another move. In the US, they use Sarbanes-Oxley Act to audit, and that audit is in conformity with what? The standards, international standard. The development of national regulatory models for the profession headed by a single unified body. That is another way of, let's see. The Securities and Exchange Commission in the US is a long-established example of a unified body. In the UK, the Financial Reporting Council also has a unified role. So we are saying that harmonization is now taking place in so many areas. And they are saying in UK, they have the Financial Reporting Council. In US, we have Sarbanes-Oxley Act, which is enforcing the usage of what? A unified standard. Then they are saying that in UK, the Financial Reporting Council also has a unified rule and sets accounting standards. So they are also setting their own accounting standard to be in uniform with what? The International Federation. Then sets auditing standards. They are also setting auditing standards as well. Then enforces and monitors compliance with those standards. Harmonization. People started it and it's working. Oversees the self-explanatory regulatory professional bodies such as ACCA and ICAEW. It has been suggested that stricter regulation from an external authority such as what? The SEC in the US and the FRC in the UK is needed to balance the increasing global power of the Big Four professional accountancy firms. Role of the regulators in protecting the interests of the public and investors. You know, every sector has its regulation or regulators. Banking sector have their regulators. Insurance sector has their own regulators, and so forth and so forth. In Ghana, we have in the banking sector, we have Bank of Ghana being the regulator to all the banks. Under the Bank of Ghana Act 2002, Act 612, and the Banking Act of 2004, Act 673, to ensure that the financial system is stable, and it is required to regulate, supervise, and direct the banking and credit system. So, Bank of Ghana is a regulator for all banking activities in Ghana. Insurance Commission is a regulator, regulating all insurance activities in the country. Specific regulatory requirements relating to financial supervision financial supervision of banks and bank auditing are contained in the Banks and Specialized Deposit-Taking Institutions Act of 2016 at 930. The Act requires that banks must provide Bank of Ghana with a copy of their financial statement each year. So that is the requirement. The Act is saying that every bank or banking institution should provide Bank of Ghana with a copy of their financial statement each year. This one will let us ask a certain question. The Bank of Ghana has the authority to request meetings with any bank or its auditors to discuss financial condition of the bank. That is another authority given to what? Bank of Ghana. It has the authority to request meetings with any bank or its auditors to discuss the financial condition of the bank. The third one is the bank should approve the appointment of auditors to a bank. So before the auditor is appointed, Bank of Ghana must sanction it. The bank may appoint an independent auditor. The bank may also appoint independent auditor to audit the financial statement of the bank. So it means Bank of Ghana is given another authority. You can also appoint independent auditor to audit the financial statement of the bank. So the question is, if a Bank of Ghana is giving all these authorities, what role did they play in the collapse of those banks? What role did they play? Because according to what we have here, the banks must provide Bank of Ghana with a copy of their financial statement each year. The second one is the Bank of Ghana has the authority to request meetings with any bank or its auditors to discuss the financial condition of the banks. You see? So if you are giving all this, should I say, juicy, chance, what role have they played in the collapse of those banks? What did they do? That's what I mean by what role. What did they do? Okay. Securities and Exchange Commission is another regulatory body. A few sections in Act 929 relate to the audit of financial statements of participants in the securities industry. Yes. There too, there is an act which you call 929, Act 929, that regulates all the insurance companies. The SEC, which we call, the Securities and Exchange Commission, simply or in a short, is called SEC. The SEC may at any time require a company participant to produce books related to its business affairs, such as documents related to the audit of a broker, dealer, or fund manager. That's another requirement. There's another power given to Securities and Exchange Commission, SEC. A broker dealers must lodge a copy of their financial statement with what? The SEC. Regulatory bodies, you see, which is what? Insurance Commission. They must what? The broker dealers must lodge a copy of their financial statement with what? The SEC. Then the broker dealers must appoint an auditor. And appointment must be notified to the what? SEC. The removal of an auditor requires SEC's consent. You can't remove an auditor who is auditing any insurance company without what? Securities and Exchange Commission's consent. So you could see that they are giving them enough power. Then we also have National Insurance Commission. NIC. Act 724 requires insurers to keep accounting records and to what? Submit a copy of their annual financial statements together with their director's certificate and the auditor's report to the commission. This is another one. This is another one. If the commission considers that any documents submitted by an insurer are incomplete or inaccurate, it can either instruct the insurer to amend the document or reject the document entirely. That is the power given to the National Insurance Commission. Then, if the commission considers that an insurance auditor has failed in its obligations, it may revoke approval of the auditor's appointment and instruct the insurer to appoint a new auditor. You see, another power given to them. The commission may at any time direct an insurer to provide it with a report prepared by the insurer's auditor on any matter that the commission may decide. Now, we also have another regulatory body, which is National Pensions Regulatory Authority, which came recently, 2008 or something like that. Organizations or trustees of pension schemes, pension fund managers, and the custodians of pension fund assets are required to keep accounts, appoint auditors, and submit a copy of their annual accounts and auditor report to the authority. That is a regulatory body. The auditor of any of these organizations must report to the board any instances they discover, such as extreme situations, etc., to ensure acting in good faith. An auditor of a trustee, pension fund manager, or custodian who contravenes or negligently fails to comply with these provisions commits an offense. So that also. Professional standards. Standard setting process. As auditors, we need to know the processes through which the standards are set. So international standard setting processes, any international standards. And by this, let me just draw something for you. We have IFAC. Okay, there's nothing I can do there. No. It's okay. Now, a committee. Now, the international standard on auditing, how is it set? Are set by the International Audit and Assurance Standard Board, which is a board or a body under the IFAC, which is part of IFAC, International Audit and Assurance Standard Board. It's a body that sets all auditing and assurance standards. They are responsible for that. So if there is anything, it is they who come out with. The next one is a committee of International Audit and Assurance Standard Board is asked to write an exposure draft of the new standard when International Audit and Assurance Standard Board consider that one is required. What they are saying is that as the process, that committee, which we call there's a subcommittee of International Audit and Assurance Standard Board. They form a subcommittee, which is responsible for making sure that any new standard that they want to set is brought into fruition. And they write an exposure draft. The committee writes what we call exposure drafts of the new standard, which the body of which we call International Audit and Assurance Standard Board considers is okay for them now. So they write an exposure draft. Then this exposure draft is then exposed to interested parties, meaning that it's given to interested parties who comment on the exposure draft. So after the exposure draft is drafted, it's given to various stakeholders, such as Auditing Practices Board in the UK and the professional bodies such as Institute of Chartered Accountants. So they give it to all participants, all the interested bodies, and they also comment on the standards, on the draft. The comments are reviewed within the International Audit and Assurance Standard Board, and the draft is amended as required. So any amendment that were being proposed will be taken into consideration when they were reviewing the draft. Finally, a new ISA will be issued. Will be what? Issued. So that is the stage. So the international standard setting process. These are the processes. Number one, if it is auditing standard, it is done by what? International Audit and Assurance Standard Board. That body is under IFAC, International Federation of Accountants. It's a subcommittee or a sub-board. Then that board, which is IAASB, set a committee or a subcommittee to write or to come out with the exposure drafts of the new standard they want to set. Then this exposure draft is given to interested parties, those who matters, to comment on the exposure draft. After they have done it, then the comments that comes out from all various organizations are reviewed within the International Audit and Assurance Standard Board, and the draft is amended as required. So they do amendment as required. These are type of what? The standards, some of the standards that we have currently. Type of standard and when applied. International Standard on Auditing. This one, when applied in the audit of historical financial information. Meaning that if you are doing a historical financial audit, is then that will be what? So International Standard on Auditing, which we call ISA. It is when you are auditing a historical financial information. We use that one. Let's go to International Standard on Review Engagements. When do we use that one? In the review of historical financial information. So please, you must be able to learn these things and know that review standards are used when you are reviewing historical financial information. Then, International Standard on Assurance Engagement. It is also used when they are in assurance engagement, other than what? Audit or review of financial information. If you are doing any other assurance engagements, which is not historical financial information, then you use what? International Standard on Assurance Engagement, which is different from what? In assurance engagement, other than audits or review of historical financial statements. So know the conditions under which every standard is being used. Then the last one, second to last, is International Standard on Related Services. This is also used on compilation engagements. Engagement to apply agreed upon procedures to information and other related services engagement. So any other related engagements, compilation, agreed upon, etc. We use International Standard on Related Services. It's not an assurance engagement. Then we come to International Standard on Quality Control. For all the above services, when you are International Standard on Quality Control, it's also there are standards on them. And you use those quality standards in almost everything you are doing. When you are doing auditing, you use the standard. When you are doing review, you use the quality control. When you are using standard on related services, you use quality control. Anything that you are doing. So that is also that for. Now continue. International Standard on Auditing. These are to be adapted as necessary when applied to audit of other historical financial statements. That's what they are just telling you. If you are doing auditing, then you use what? ISIS. If you are using ISIS, that means you are doing actual auditing. Then International Standard on Quality Control. This one applied to all services carried out under the what? International Audit and Assurance Standard Boards. Engagement standards. Any standard, anything that you are doing, any assignment that you are giving, you use what? International Standard on Quality Control. Okay? The nature of the international standard requires the professional accountant to exercise professional judgment in applying them professional what? Judgments in applying them. Let's look at now the International Audit and Assurance Standard Board Clarity Projects. Clarity what? Project. In 2008, the International Audit and Assurance Standard Board issued a final Clarity Project update. Clarity Project update. What is clarity? Approval by the Public Interest Oversight Board slightly ahead of December 2008. What does that mean? In 2005, the International Audit and Assurance Standard Board came out with a committee, or came out with what you call clarity projects. Clarity means, you see, despite all the standards and the way we are practicing them, still the auditing profession was in question. Example was, what do you call it? Error. Upon all these standards, error collapse. When error collapse, the audit firm, Addison, also what? Collapse. So, in fact, it was very blue to the body. So, they have to come out with what? What we call clarity projects. So, in October 2008, the International Audit and Assurance Standard Board issued a final clarity project updates. Approved by the board, the Public Interest Oversight Board, slightly ahead of what? December what? 2008. The clarified issues, that's ISS. They came out that some ISS were working effectively, others are not effective. That is, understanding of them and how they are put into practice were in doubt. So they came out with what? Clarified ISS. Some of them, they clarified them, they reviewed some of them, and they brought in new ISS. So the clarified ISS came into effect for audits of financial statements beginning on or after 15 December 2009. So it means that these clarity projects, they came out that some of the ISS need to be what? Reviewed. Some of them need to be fully clarified. Others, new ISS need to be introduced. So they came out, and these ISS that were reviewed, some were clarified or whatever it is. Key points from this update are as follows. It was 18 months comprehensive review. So meaning that they worked for 18 good months. 36 clarified ISS were issued. Meaning that they came out what? 36 ISS that they clarify. They have to clarify because understanding of them may not be so good. That's where the auditors were, despite all these regulations, auditors were doing their thing. So 36 ISS were issued. That's clarified and issued. Along with clarified international standard for quality control. So they did that also. They clarified that also. 16 of the ISS were substantially what? Revised, as well as what? Redrafted, and one new ISA. So the new ISA is what? 265. So all these ISS were issued. The other 19 ISS were redrafted, but not revised. So some were redrafted, some were revised, and a new one was also introduced. Now, summary of the main changes in the new ISS. ISA 200, they have brought a new thing inside. And they are saying that the overall objectives of the independent auditor and the conduct of an audit in accordance with international standard on auditing. ISA 200. So they have made some changes in the new ISS. Then ISA 210, agreeing the terms of audit engagements. How you should come out and agree on the terms of the engagements. Then as at 260, communication with those charged with what? Governance. These ones, all of them were revised. Some of them were revised. Some of them were redrafted, and the rest. Then 265, communicating deficiency in internal control to those charged with governance and management. I said 230, materiality in planning and performing an audit. And then what? Audit consideration related to entity using a service organization. So all these ones, either revised or redrafted. Evaluation of misstatements, identify during an audit. External confirmations, how external confirmations should be done. Auditing accounting standards, they also revise or what? Including fair value accounting estimates and related disclosures. There are related parties. I said what? 550. They came out with what? Related parties. Written representatives, special considerations, audit of group financial statements, and so using the work of an auditor's experts. The objective of the auditor per ISA 200 are to obtain reasonable assurance. To obtain what? Reasonable assurance about whether the financial statement as a whole are free from material misstatement, whether due to fraud or error. So that is the main objective of what? ISA 200. And for the work of auditor, that is the main job. That is the main job. Now, to report on the financial statement and communicate as required by the ISS in accordance with the auditor's what? Findings. ISA 200. Continue. It also requires the auditor to comply with all ISS. All the ISS we enumerated above. If you are doing audit job, you need to comply with them relevant to the audit. You must also comply with relevant ethical requirements. Yes, as auditor, you need to be ethical in whatever you do. Therefore, all ethical requirements, you need to comply with them. Plan and perform an audit with professional skepticism. Professional skepticism, meaning that plan and perform the audit with what? Open eyes. That is looking deep into the system. And if there is any misstatement, you can easily come out with it. Professional skepticism. With open mind. With questioning mind. Questioning what? Mind. Then exercise professional judgment in planning and performing an audit. I said 200, that is the requirement. So obtain sufficient appropriate audit evidence to allow him to what? Obtain reasonable assurance. Without this thing, you cannot get what? Corporate governance is also another topic we need to discuss. What is corporate governance? They say is the way in which companies are managed and controlled. What's the meaning? They say corporate governance is the way in which companies are managed and controlled. An important feature of companies is the divorce of ownership from management. So what they are saying is that the owners of the company are different from the management. Those who manage the company are different from the shareholders. The directors manage the business and make the important strategic decisions. The shareholders finance the company and own it. Therefore, there should be corporate governance, good corporate governance. Directors are seen as agents of the shareholders and as agents of the shareholders. They take decisions that are in best interest of their shareholders and are accountable to the shareholder for the way in which they have used the company resources. Yes. Directors and auditors' responsibility. Yes. Directors are responsible for what? A, B, C. Auditors are also responsible for D, X, Y, Z, and so forth. So let's see. The directors are responsible for what? Preparation of the financial statement. We discussed it earlier. Who prepared the financial statements? The responsibility of the management. So it is the directors are responsible for what? Preparation of what? Financial statement. They put internal controls in place. That is another one. Providing the auditor with what? Access to information relevant to the preparation of the financial statement. Additional information relevant to what? The audit, to audit. Then unrestricted access to persons, and then representations. These are responsibilities of the directors. The auditors are responsible for reviewing that information and in some cases reporting on the extent to which the directors have complied with their responsibilities. Since auditors have a responsibility, directors have the responsibility. Auditors also have their responsibility. So one of the auditors' responsibilities is to make sure that the directors comply with their responsibilities. It is good practice in accordance with ISA 210, agreeing the terms of audit engagement to clarify the relative responsibilities of the directors and auditors in corporate governance matters. The Code of Best Practice. The Code of Best Practices for corporate governance applies to what? All corporate bodies approved or licensed as stock exchanges, dealers and investment advisors under the securities industry law. The managers, operators, trustees, and custodians of unit trusts and mutual funds, and the issuers of what? Publicly what? Traded securities. So it is good for all these people to practice good practice. To practice code of best practices. Compliance with the provision of the code is optional and not enforceable by law. That is the disadvantage. So nobody will take you to court for failing to comply with what? The code of best practices. In Ghana, the code of best practices in corporate governance stipulate that in Ghana, we have code of best practice. They are saying that the audit committee should comprise at least 3 directors. So the code of best practice in Ghana states that we should have what we call audit committee. And this audit committee should comprise at least 3 directors, the majority of whom should be non-executive. At least, if you have 3 directors, and at least majority should be non-executive, so 2 should be non-executive. But if you take about 5 directors, then it means that you can take what? Non-executives about 3, and then executive like 2, or you can take any other one, but it should not be less than the 2. The chairman of the committee should be a non-executive director. Non-executive director, yes. The managing director or chief executive officer, the finance director, the head of internal audit, and representative of the external auditors should ordinarily be invited to attend meetings. So they shouldn't be members of the audit committee. Some of the primary functions of the audit committee are: every committee has a function. Therefore, audit committee has its own function. The first one is to recommend the appointment of the external auditors. The second one is to review with the auditors their report on the financial statements. So if the auditors finish their reports, they send it to the audit committee, and the audit committee sits with them to review it. Report to the board on all issues of significant ordinary financial transactions. Yes. You should also report to the board. The audit committee report to the board on issues of significant ordinary financial transactions. Extraordinary. Okay. The next one is they assist the board in developing policies that will enhance the controls and operating system of the corporate body. So the audit committee assists the board in coming out with what? Internal controls that will be effective. Authority of the audit committee in Ghana. As far as Ghana is concerned, what is their authority? The Code of Best Practices in Corporate Governance stipulates that the audit committee should have the authority to investigate any matter under its terms of what? Reference. That is one of the authorities. should have the authority to investigate any matter under its terms of reference. The next one is to be provided with what resources it needs to carry out such investigation. Means that the audit committee should be given enough resources to enable them to perform their job or duties. Be given full access to necessary information. That's also another role that they play. We are now coming to another judicious topic: money laundering. Money laundering. What therefore is money laundering? We all know that whenever everybody or any of us have a dirty cloth, our clothing are dirty, we send them to laundry to make them clean. So money laundering is getting a dirty money, making it sure that it becomes a clean money. So money laundering can be defined as the process, that is the means by which criminals attempt to conceal the true origin and ownership of the proceeds from their criminal activity. Criminal activity is a dirty game. So if you go and do criminal activity and you get some money, and that money need to be clean, to make it very clean so that nobody will have a question to ask. Criminal activities include drug trafficking, terrorism, thefts, tax evasion, and other types of fraud. So all these are criminal activities. So if you get money from any of these sources, it's a dirty money. You need to what? Send it to laundry for cleaning. Money laundering is a process by which money earned from criminal activities, that is dirty money, is transferred and transformed so that it appears to have come from a legitimate source. That is a clean source. So that is the mean, that is the money laundering is cleaning of what? Dirty money, to make it all look clean. There are 3 phases to this. The first one is placements. What is placements? To place the money. This is when the criminal places illegal cash in what appears to be legitimate business transaction. He places, for example, illegally obtained money could be added to cash takings in a restaurant, shop, or other business so that it looks like it has been obtained via legitimate. That's what many people do. They will be doing some other businesses which is illegal. And get dirty money from them. Once they have a shop, they'll be adding it to the shop as if the shop money, as if all the money are coming from the shop. Nobody will even know that they are doing fictitious jobs. Layering is another one. In this stage, the funds move through several transactions or layers. The transaction will be complex and may move the funds between different countries to make the source of what? The illegal funds more difficult to trace. Yes, that layering means placing the money through so many what? Jurisdictions. Let's take, for example, you go and then you manage to do some cocaine business. Then along the line you manage and the cocaine went to, let's say, US, and you have sold it. How to bring the money directly to Ghana becomes a problem. So what they normally do is that they will make sure that they will send the money to, let's say, South Africa. From South Africa, they will go to another country. Then from another country, you go to another country. Instead of the money from US straight coming to Ghana, by the time that it reaches Ghana, if they are making it difficult for anybody who want to trace the roots of the money, it will be difficult for the fellow. That's what they are doing. So they are layering it. And in this stage, the funds move through several transactions or layers. The transaction will be complex and may move the funds between different countries to make the source of the illegal funds more difficult to trace. So if you want to trace the money, instead of knowing that the money is coming from US to Ghana, you go to South Africa, then you go to probably Australia, then move to another country. Then in that case, it will be roaming. But finally, it will land in Ghana. When it lands in Ghana, then it has come for what? Chop chop. That is what we call integration. Integration, what is it? In this final stage, the funds are moved back into the economy to convert them into a legitimate form. For example, the purchase of property. So integration is where the money has arrived in Ghana, let's assume. Now, how do you dispose of that money? You buy assets, properties, and so many things. That is one of them. So you are trying to integrate the fund, the illegal money you have acquired into the system. So now you are a rich man. You have a lot of properties. You have integrated it. Examples of money laundering include what? Possessing in any way, dealing with or concealing the proceeds of any crime such as tax evasion, retaining overpayment from customers. All these are illegal means. Attempting, conspiring, or incitement to commit the above offense. Aiding, abetting, counseling, etc. And then an act which would constitute any of these offenses if done in Ghana. Alright? In Ghana, the following form Ghana's regulatory framework for what? Money laundering. We have, this is the structure of our anti-money laundering in Ghana. We have Anti-Money Laundering Act of 2008. All of you, when you go to your banks, check the bank. They may have some notices placed on the wall. Anti-Money Laundering Act 749. Then we also have Amendment to Anti-Money Laundering Act 2014 at 874. Then we have Anti-Money Laundering Regulation of 2011. That is LI 1987. Then the 2016 amendment of the Ghana's Companies Act 1963. That is at what? 179. All these are acts and regulations are on what? Money laundering. Obligation placed on professional firms. Yes, all professionals and the other professional firms are obliged to put some issues or some things in what? In motion. That means that as a professional auditor, you are obliged to do some things. As a professional firm, auditing firm, or any other job as a professional, you are given an obligation or areas you have to play. There is a role you have to play as far as money laundering is concerned. The first one is putting into place systems, controls, and procedures. So every audit firm or any professional organization should put what? Systems in place. Controls and procedures in place. Systems, controls, and procedures in place. The next one is appointing money laundering reporting officer. This particular one is clearly seen in banks. Appointing money laundering reporting officer. There should be a dedicated officer in the organization who will be responsible for what? Money laundering activities. It's a money laundering reporting officer. So you will report. The next one is establishing and enhancing the record keeping system. As a professional firms or organization, you need to what? Make sure record keeping systems are enhanced. So that if there is a money laundering activity going on, it can also come out. Establishing procedures within the firm for reporting any suspicion of money laundering. Meaning that you put in place within the firm a reporting structure or a system in such a way that if anybody suspects money laundering, the fellow can peacefully what? Reports. Then the next one is training and educating staff in procedure for detecting and reporting suspicion of money laundering. Yes, money laundering is illegal activities. And the people are doing in such a way that they will hide from being noticed. So they should train all staff and educate them the procedures for detecting what? And reporting what? Suspicion of money laundering. Okay? Still here. Consideration of laws and regulations in an audit of what? Financial statements. ISA 250. So those of you who will be very soon auditing public institutions, you are supposed to learn more about ISA 250. What are the issues that we need to consider when you are auditing financial statements? 1, the effect of the non-compliance with laws and regulations. What effect will it have on the work you are doing? The effect of non-compliance with laws and regulations. Compliance with these laws and regulations is fundamental in order for the audit, also for the entity to operate or avoid material fines. Examples include complying with the terms of an operating license. Yes, every organization has to get a license before they operate. So you make sure the license that your clients need to obtain, they are complying with the conditions and the terms of that license. Compliance with the terms of operating license. Then you must also make sure that complying with regulatory solvency requirements. Like recently happened to the banks, some banks. They refuse to what? They fail to comply with the Bank of Ghana regulation. That directives. Therefore, they fail to comply. And therefore, it is your duty as an auditor to check all those before you issue your report. Then comply with our environmental regulations. You know, we live in an environment. Therefore, there are environmental laws and regulations. EPA has specified some things that need to be done as far as companies are concerned. So your clients need to comply with all those ones, and you have to check and see whether they are complying or not, and give assurance whether they are doing it or they are not doing it. So responsibility for compliance with laws and regulations. Who is responsible for that in the companies? Management can implement policies and procedures to assist the prevention and detection of non-compliance with such as what? Monitoring legal requirements. So management is responsible for what? Making sure that company complies with our laws and regulations. It is not the auditor's duty to do. It is the management responsibility. By monitoring legal requirements, what are the legal requirements of that company? So they have to know and monitor them. 2, ensuring operating procedure meet legal requirements. That their operations are in conformity with the what? Legal requirements. Then maintaining a record of what? Maintaining what? A record of complaints. Yes. Maintaining a record of what? Complaints. If there is any complaint, you have to keep record of them. Then establishing and operating appropriate internal control systems. We were all informed that internal controls are put in place by management. So if there is a deviation from any procedure, you have to amend it, establishing and operating appropriate internal control systems. Then developing, publicizing, and what? Following code of conducts. That is the management responsibility. Training employees on the code of conduct. It is management responsibility. Monitoring compliance with the code of conduct. And disciplining what? Employees who breach the code of conduct. It is management responsibility. This one here. Can you?
So this one, since we don't have time to edit it, we can use Zoom to do this. So we can move it.
Okay. Well, I can read it as it is small.
As is.
I can read it. Okay. Okay. Consideration of laws. That's ISA 250. Consideration of laws and regulations in an audit of financial statement requires the auditor to what? Obtain a general understanding of the applicable legal and regulatory framework and how the entity is complying with that framework. What I mean is that as an auditor, you're auditing a particular firm. That company you're auditing operates in what? A particular system. Let's say it's a banking institution. All the activities should follow or should form in conformity with the Bank of Ghana laws and regulations. So that is your duty. If it's an insurance company, they should fall within the confines of what? National Insurance Commission, and so forth. It is your duty to make sure those things happen. Obtain sufficient appropriate audit evidence in respect of compliance with those laws and regulations. So it is your duty as an auditor to obtain sufficient appropriate audit evidence in respect of compliance. So when they shouldn't use their mouth to tell you that we are complying. If they are complying, you should test it and see whether on ground is this happening. Then perform the following audit procedures to help identify such instances of non-compliance. So you must perform the following work procedures to help identify. Then make inquiries of management as to whether or not the entity is complying. You must also find out from management whether they are they sure that they are complying with the laws and regulations. Then inspect any correspondence with the relevant authorities. You must also inspect any correspondence. Ask for correspondence with your clients, your client with that of EPA, and see you see the deviations. If they are being charged or there is an investigation going on, it means they are not complying. During the audit, remain alert to the possibility that other audit procedures might bring instances of non-compliance. Yes, they say it should be alert to circumstances that these things may be happening, but you will not see it, but be alert to it. That the company may not be complying with some laid down regulations. Obtain written representation from management. Yes, you must obtain written representation from management that all known instances of non-compliance or suspected non-compliance have been disclosed to the auditor. They should write to you officially that, yes, as to the best of their knowledge, all instances of compliances are being complied. Or where there is a deviation, you have to find out from them. Document all identified or suspected instances of non-compliance. Document everything, because documentation is what auditors rely on. So document anything. Any identified or suspected instances of non-compliance, document it. That's what you are going to use as part of your report. The results of discussions with management and other parties. If you discuss the issue with management and other parties, indicators of non-compliance. Now, a scenario question may be given to you, and these things we are going to discuss now. Some of them may be in the scenario questions, and then you have to find out whether they are complying or they are not complying. And they are saying that indicators of non-compliance. Anytime you see any of these, it means the company is going to comply. Sales commissions or agent fees that appear excessive in relation to those ordinarily paid by the entity. Yes. They will tell you that sales commission, they pay 5%. But in some instances, you see sales commissions 20% and the rest. So why is it 20 now? In some, that means they are trying to hide some things from you. Purchasing at prices significantly above or below market price. Some prices may be so huge that if you compare to the market price, no, you cannot. That means they are not complying with rules and regulations or some other things. Unusual payment in cash. Purchases in the form of cashier's checks. Yes. Most Ghanaian organizations, no more, I don't think there are even few of them that will use cash. You are using cash for payment, purchases in the form of cashier's checks, and then the rest. No, they are saying unusual payment in cash. Unusual, meaning that the payment is not usual. It's not the traditional way of spending money by that particular company. So then unusual transaction with companies registered in the tax havens. Yes, where you have a company in the tax haven and your client is dealing with that company, it is non-compliance. It's indication that you are not complying. That means you are evading tax and the rest. Payment for goods or services made other than the country from which the goods or services originated. Yes, you make a payment, instead of the payment going to Lagos or Nigeria, you made the payment to, let's say, Cote d'Ivoire. Then from Cote d'Ivoire, the payment go to Senegal. From Senegal, it came back to, let's say, Niger, before it landed in Nigeria. So in that case, then there's a problem somewhere there. Payment without proper exchange control documentation. Every payment needs to be controlled by a document. So if they made a payment which there is no proper documentation is on, then it is trying to tell you that they are trying to avoid some things. They are not complying. Action by the auditor in the event of non-compliance or suspected non-compliance by a client. Yes, where you, the auditor, you suspected that there may be non-compliance. What are the steps you have to take? 1, obtain understanding of the nature of the act and the circumstances under which it has occurred. So obtain an understanding of the nature of that act and the circumstances under which it has occurred. That's the first one. Second, evaluate the possible effect of the non-compliance on the financial statement. The non-compliance which you come across. What is the effect on the financial statements? Then, for suspected non-compliance, discuss the matter with management. Whenever you suspect non-compliance, discuss with the management. If the compliance is not demonstrated, take legal advice. So, discuss non-compliance with management. So that at least they'll give you their side of the story. Then, if there is insufficient evidence of suspected non-compliance, consider the impact on the audit reports. So, if there is insufficient evidence of suspected non-compliance, consider how it will impact on the audit reports. Consider whether or not the non-compliance impact on other areas of the audit. And then consider how to report the non-compliance to those charged with governance, or to shareholders, or to the authorities. So these are, now let's see. Thank you very much.